Hello and welcome to Ticker Tapes. Today we're taking a look at the world of ETFs, and specifically, we'll be looking at funds that cover the S&P 500, high-growth stocks, treasuries, oil, and healthcare. Starting with the S&P 500, the sell-off in U.S. equities continues as investors move out of stocks that are negatively correlated to rising interest rates. And though some of that money is finding its way into sectors and strategies that should benefit from higher rates, that hasn't been enough to keep quality indices and the instruments that track them from falling. SPY, the ETF that tracks the performance of the S&P 500 index, fell last week and is down the best part of 5% year to date. We don't have to look very far for the culprit. The S&P information technology sector is down by 8.40% over the year to date. More than twice as much money left SPY than ETFs that track the NASDAQ 100 or the Russell 2000 indices over the last week, even though those indices have fallen farther and harder than the S&P 500. Holders of the ARK Innovation ETF might like to look away from the screen now because last week's performance was anything but pretty. The actively managed fund, which holds a portfolio of growth technology and disruptive stocks, fell by 12.91% last week, is now down almost 20% year to date, and by 48% over the last 52 weeks. More than $577 million left the ARK Innovation ETF last week, and the value of assets under management in the fund are now down more than 50% from their high point of $28 billion in less than 12 months, and it's not clear when this bloodletting will end. Despite a sharp rise in bond yields over the last week, TLT, the iShares 20-year plus Treasury bond ETF, held up well, falling by just 1.73%. Remember that bond prices fall as their yields rise, and of course, those lower bond prices will be reflected in the performance of TLT. However, movements in the bond market tell us that investors think that interest rates will be higher over the short to medium term, that's 5 to 7 years, and then start to fall back thereafter. 20-year bond yields peaked last week at 2.45%. That's not to say that they can't go higher, rather that they just don't want to at the moment. USO, the U.S. oil fund, the ETF that tracks the performance of WTI crude oil, rose by 4.97% last week and is up by 12.30% year to date, during which time its price has posted an impressive 16 new highs. However, the good times may not last indefinitely according to forecasts from the EIA, who have predicted that oil prices will decline throughout 2023 as global production catches up with demand. That presupposes that bottlenecks in the global supply chain for energy can be removed. Oil prices were boosted this week by a drone attack on facilities in the Gulf state of Abu Dhabi, responsibility for which was claimed by Houthi rebels from Yemen, though some analysts suggest that Iran could really be behind the attack, which might serve as a warning for the Emirates to stay out of the rebels' long-running conflict with Saudi Arabia. And last but not least, it's been another week of losses for the S&P 500 healthcare sector ETF, which fell by 3.77% and is now lower by 6.56% over the year to date. As with SPI and ARK, the ETF and the healthcare sector is being hampered by the market's newly found dislike of growth stocks, of which there are many in both the sector and XLV. In fact, over the last 5 trading days, only 6 stocks in the sector have made any gains at all.